This is the financial accounting tutor back with another notes receivable problem. So let's get started. Lemming makes an $18,750 120-day 8% cash loan to Notions Company on November 1st. Lemming's end of period adjusting entry on December 31st should be. Okay, so number one, you gotta know what adjusting entry is. Remember, adjusting entry is to bring your books up to, accrual basis. Because in this problem, we're accruing interest every day. Every day this loan is outstanding, we're accruing interest. We should be theoretically, we should put on our books, we should be receiving interest every day, even though we haven't been paid. That's what adjusting entry is. Bringing your books, up to, accrual. So what you got to know about adjusting entry is adjusting entries always involve at least one balance sheet account and one income statement account. And it doesn't matter what adjusting entry you're doing. You can be doing accrued revenue, accrued expenses. It doesn't matter. Adjusting entries always involve at least one balance sheet account and one income statement account, no matter what. So if you know that, we can at least eliminate some problems here, eliminate some answers here. So we can eliminate A, debit cash for $250, credit notes receivable for $250. They're both balance sheet accounts. Both of them are balance sheet accounts. They're both asset accounts. So we can get rid of that. Let's see, what else can we get rid of? Okay, that's the only one that we can get rid of. Now, let's look at B. Debit interest revenue for $500, credit notes receivable for $500. Well, we're the ones receiving interest revenue, so we're not going to debit interest revenue, because if we debit interest revenue, that means our revenue account is going down. Remember, debits decrease revenue, credits increase revenue. So we know that's not right. Our revenue should be going up, so we can get rid of that. Let's see, what else we got here? Debit interest receivable, interest receivable, so C and D, that's a possibility. E, debit notes receivable and credit interest revenue. Well, our notes receivable is technically not going up. Our note is not changing. Our interest receivable is going to be changing. So we know it's not going to be E. Notes receivable. Our notes receivable is not going up. Our interest, remember, we're only getting paid back on it. Well, we're not only getting paid back on the interest, but those are basically the extra payments that they make for us, since we lent them the money. They owe us interest receivable, interest revenue. Okay, so we know it's going to be C or D. So how are we going to calculate that? Let's go right here. So we got to find out, when did we issue this note? We issued it on November 1st. Okay. Now, since we issued it on November 1st, we technically won't start recognizing the interest until November 2nd. That's the first thing you got to know. We won't start recognizing interest until November 2nd. So, because just think about it, this would be like you taking out a car loan and paying it off the same day. Let's just say you took a car loan off on September 10th and you paid it off September 10th. There's not going to be any interest involved because you paid it off the same day. This works the same exact way. So there's 29 days left in November. There's 30 days in November. There's 29 days left. And then we have all of December. So there's 31 days. 31 days in December. So that means we need to recognize interest for 60 days. Now, how are we going to calculate that? Remember, we're going to take the $18,750 times the annual rate, which is 8%, times 60 days over 360. And like I said in the last video, just check and see what your accounting book is using. Like I said, I use 360 because, it's going to be, it's going to be easier to round with that number. There won't really be any rounding, but just see what they're using. Okay, so now let's see what we need to do. And another thing you need to realize is, do not use this 120 days right here. Do not use that. We're not using 120 days. That's how much the loan is. That's how many days they have until we're going to get paid back, 120 days. We're not going to use that. We're going to use the 60 because there's 60 days from November 2nd to December 31st. Now we just need to do our calculation now. So we've got 18,750 times 8%. And then we're going to take the 1,500 times 60. And then we're going to take the 90,000. And it's going to be divided by 360. So that gives us 250. So the answer to this problem is going to be interest receivable 250 and credit interest revenue 250. Remember, when adjusting entries, one balance sheet account, one income statement account is always going to be involved. Interest receivable is our balance sheet account. Interest revenue is our income statement account. If you like this, please subscribe, like I said, so you can always be up to date on, these problems. They can be tricky. Accounting can be tricky to understand. So I'm trying to make it easier for you to understand so you can pass your class. I'll see you in the next video.